Good morning, everyone. I want to acknowledge the First Nations people of Australia across the country from wherever you are. I'm on Wallumattagal land and want to give acknowledgement for their elders, past, present, and emerging. Welcome to our presentation on bookkeeping. You've got myself as the Vice President of the Childcare Alliance, Paul Mondo, who is the President, and is heading up our worker retention payment team, which we're now one of the 8 organisations across the country who've been entrusted by the government to help you get through this. Both Paul and I have our own centres. Both Paul and I are going through the process ourselves, so we really do understand the frustration and the challenges that this is bringing up. The Australian Childcare Alliance represents over 3,000 services across Australia. You don't need to be an ACA member to be watching or learning from this webinar, and we encourage you all to get in touch. Paul, do you want to talk about our WRP support services?
Yeah, thanks, Nesha, and good afternoon if you're on the eastern seaboard of Australia. And I just want to acknowledge for those of you in services each and every day, this has been a really difficult week, and I must say it is rather nice. I never thought it would be. I would say it's nice to talk about the worker retention payment after the last 6 months, but actually after the really challenging environment of this week, I'm really pleased that we're able to talk about the worker retention payment. So, as you know, and as Nesha pointed out, we are entrusted to support services with all steps of this process. And I encourage you, if you have any specific queries, to reach out via the 1300 number, the email address, or accessing resources via the website. At any stage. This is a moving feast of information that's needed. Please don't ever hesitate to call. If you don't get through first time, leave a message, and we will certainly return your call as soon as we possibly can at that particular point in time. But please, please, please do not hesitate to ask questions.
Of course, though, I'm just about to say you can ask questions at the end of this session. If we have time, we'll answer them live during the session, but if not, we'll add it to our FAQ webpage. To stay on track and on time, we're just not going to be able to answer questions during the presentation. So if you desperately need to, you can type it while you think it. The likelihood is we'll answer it during with the information, but we're not going to be able to get to that until the very end, partly because while I'm sharing my screen, I can't see what the questions are. So that's partly why. So what we are going to cover today is reviewing the grant signing, reviewing the grant agreement, say that 10 times fast, for signing, receiving money, hints on tips on how to set it up in your payroll system, and managing an internal reconciliation process, which is a lot harder than you might think. Handling funding reviews, navigating the award increases that have just come through as of the next full pay period, back pay and staff departures, and where to find additional support and resources. What we won't be covering is whether or not to apply, which workplace instrument to choose, or how to apply. We've done that before, and you can log into your ACA member portal or just contact the team. Again, if you're not an ACA member, we can give you links to all of those webinars, and you can also talk to the team while you're there. Paul, if someone hasn't applied yet, what do they need to do?
So very, very importantly, most of you will have noted, if you haven't applied yet, that the extension to apply and receive back payment very late in the piece was extended to September 30, 2025. So there is still an opportunity to apply if you haven't applied yet and get back payment to the 2nd of December. In terms of workplace instruments, there is some flexibility as to those workplace instruments. Again, call the team. It would be best to make those inquiries, and we can deal with that specific to your circumstances there. But all I'd say is, if you are thinking and you're going to do it and you haven't done it yet, get started. Don't wait, because September 30 ain't that far away once you to undertake that process.
So next one's again for you, Paul.
Yeah, absolutely. So look, I think we're trying to work through this is, we're assuming that most of the people on this call have applied for the grant and have either received their grant agreement, executed their grant agreement, have received their first payment, and are in the process of talking about how they can do this and put this into practice for themselves so that way, this becomes a practical exercise. I'll say very, very clearly that there are, the grant agreement is a legal document which has a whole lot of T's and C's that are really, really important. We're not going to go through all of the T's and C's here, but we're going to talk through what has been the most common query for people to understand about their grant agreement from there. This slide shows two highlighted dollar values there, and those dollar values are really, really critical. The first of which, and I'll start with the one on the bottom in green, which is the historical leave liabilities. In your application, you would have listed some leave liability amounts based at your accrued long service, personal and annual leave as at the 2nd of December 2024. If you have received your grant agreement, the government has accepted those numbers and the evidence you provided and calculated what it expects the top-up payment to be to put into effect those historical leave liabilities with 10% arrangement. That number is a one-off payment, and that number is, you would need to be comforted that number reflects the top-up based on the historical leave liability balances that you had provided evidence for and entered into your application form.
And it's not, so Paul, it's 10% of 70%.
Yeah, so it might not be an exactly 10% of the amount that you have, but I think you would be able to equate the number very closely to not far short of 10% of the balances that you entered into your form. That will be the first payment you receive, and we'll talk about payments a little later on down the track.
Jump to that very quickly. That comes up as your first payment, and if you have a look here, it doesn't say when you get the payment that it's the historical leave liability, but that amount there matches exactly what's in the contract to the cent.
Absolutely. And so once that happens,
that one's your HLL.
Yeah, and that is just a one-off payment. You'll never get another payment that aligns like that so neatly and so clearly, but it gives you an easy way to reconcile the amount in with the agreement itself. The second amount that is really important, and this may provide some concern for some of you, what the government has done, it has estimated what it expects to be the total number or total value it will pay out to you, or the maximum value it could pay out to you across the 2-year cycle of the grant itself. To determine that number, it has used your childcare subsidy session hours in the September quarter of 2024 and extrapolated that over a 2-year period to estimate how much you will receive. Now, I will flag a couple of things to think about for you, and this will be different for each of you in the circumstances that you're in. If your service is a service that's been operating for a while, and that specifically, the September quarter is representative of your normal cycle of enrolment and occupancy for that period of time, and that will be relatively consistent from an average perspective over the 2 years of the grant, it is highly likely that maximum grant value will be pretty close to the amount that you'll receive and pretty suitable for your service and its arrangements there. So those services that have been operating have had a reasonable occupancy, or that occupancy is going to be consistent with the occupancy in the following 2-year period. We expect this number to be on the money for you in terms of the amount you will receive. What is important is a grant process by government is a formal process. It has a bucket of money that the government has attributed that it will estimate that it's going to cost over the period of the 2 years for that. The government has to put a maximum amount it is going to indicate it will pay you, because it can't effectively write a blank check by saying, we don't know how much we're going to pay you, we'll just pay you whatever, and hence why they've put this maximum grant value.
Goes into budget estimates.
Yeah, and the time that this might be a challenge for a provider, and we've had this come to us a number of occasions, is if, in particular, if you're a relatively new service and your occupancy is relatively low because you have been trading up, you'll be trading up over a period of time. It is clear that the government can only make an estimate based on the data it has available for your service. But if it's basing its estimate because your occupancy was at 20% there, but actually, 8 months later, we're already at 50%, there is a chance and a likely chance that the maximum cap value might be hit before the 24 months of the worker retention payment concludes there. What I would say to you is two things. The government has indicated that it will be monitoring services against their maximum grant value and contacting services about 2 months out from when they would anticipate you reach that maximum grant value if it is going to happen before the 24 months is out. I hope that that's true and that they will follow through with that particular timeline. I would encourage you, and we'll talk about this a little later, for you to continue to track the amounts you receive versus your maximum grant value so that you could proactively reach out to the government about 2 months, the department, about 2 months before you anticipate you might exhaust that particular maximum grant value to seek an extension of that maximum grant value. Again, I think that this risk only applies to services who were new and have low occupancies in the over the last little bit and who are trading up, whereby you're going to have more staff, therefore you're going to be paying more worker retention payment and more children associated with that. So just keep that in mind. It's something that you should monitor and you should control.
So the first payment that people get, Paul, is going to come through again when you go into your provider entry portal, which is the only way you're going to find out the details, because you're not going to be getting a weekly email. You're not going to be getting any of that like you might do for other government grants. It comes up and it looks like this. So this is the first payment that has come through. Talk to me about that, Paul.
Yeah, so we spoke about the fact that historical leave liabilities is a one-off payment. That was the previous slide and the previous number, and that comes in. You'll reconcile it. It's pretty straightforward, and you know that's done. And often that will come before you actually get your worker retention payment itself.
And that is a figure that you can 100% match to what's on that contract. And it's important that you recognise that, because often the figures are fairly similar.
Yeah. Now, this payment here that's being highlighted is actually the first worker retention payment for this particular service in question here. The worker retention payment itself, and as Nesha points out, this is a slide for those of you who are familiar with the provider entry point. It's in your payment screen in your provider entry point. And often that your worker retention payment could be lumped with, I'm having that tongue twisting moment as well now, Nesha, lumped with your regular CCS payment that most people will receive on midnight Wednesday morning. Tends to be a pretty common cycle if you lodge on a Friday night or over the weekend. And it can be lumped in the middle of your other regular CCS payments. Those payments occur on approximately the third week of every month, and it will deal with the period in arrears. And there is a cycle coming up that we'll show you shortly that highlights that amount there. So what I would say is when you get your historical leave liabilities, the time lag between then and your first worker retention payment might not be consistent from service to service. It will depend on when you execute your grant agreement and ultimately, how that fits in with the particular timelines of their worker retention payments. Noting that the worker retention payment itself is paid monthly in arrears, albeit your first back payment will be so if the next payment run for worker retention payment is approximately going to be the third week in July, and you will receive a payment which effectively covers the 2nd of December to sometime towards the end of June as a payment run from there. Your next payment, if you are would be receiving roughly the third week of August, which pays up until the end of July, effectively.
Yep. So These are the payment cycles that we're looking at, Paul. These are from earlier this year. And you can see, for example, what Paul just said there, the payment that was received in, I can't see that. I've got your face in front of that a little bit. Sorry.
Yeah, I could talk to it if you like. The payment that was
You go.
received,
Go nuts.
the payment with a payment date of the 21st of the 3rd, which would have got to services probably within the 3 or 4 days following that, covered a particular period that was highlighted there. So you can see the March payment deals with effectively February as the payment that was received. Now, importantly, it talks about particular dates, and very, very clearly, because we're linking payments to CCS session hours, those payments capture a Sunday week ending date. You know, that is 2 CCS fortnights that it is capturing in the particular context of that. So keep in mind that when we say approximately the end of the month, it has to align with CCS fortnightly cycles to ensure that the CCS session hours are workable in that context.
And don't get excited when you get your first payment. Remember, that includes the back pay. So don't think that's what's going to happen every month. What you can see here is what Paul was talking about, that if you have a look at this cycle of CCS payments, so this is a service that I know very well, who you can see each week, you can see the CCS coming in, and then once a month, there's that bump of what this service is getting. And then you can tap into that and see that extra line that says the worker retention payment that we showed a couple of slides ago. I'm just going to go back to it very quickly. That looks like this. So that's it. They won't tell you what's historical leave liabilities. They won't actually tell you what dates, but you get the idea that when you're getting something towards the end of May, that's covering basically once you get into the cycle and you've covered your historical leave liabilities and your back pay, after that, it should be a fairly easy cycle for you to be able to follow.
Yeah, and one thing I will say is I acknowledge that one of our representations to the department has been very clearly that the lack of clarity around what periods the payment covers, what it is funding specifically, and what that looks like require. You know, we have implored for the department to come up with some way of giving services the level of detail needed to understand what it is receiving and when. And I believe that there's certainly an understanding of why we need that as a sector for all sorts of administrative purposes, but also so us to be able to reconcile to be assured that the money we're receiving is enough to fund the cost of implementing the pay rise there. And so we would hope that at least at some stage soon we might get some level of reconciliation that deals with the period 2nd of December till the end of June at the very least to assist us with that. And no doubt we'll wait and see whether the department's able to deliver that in the future.
All right, so Paul, you need to go through back pay. How do we arrange back pay?
All right, so back pay is certainly one of the more onerous tasks for people who have not paid the grant up front, which probably turned out to be a really wise decision considering the processing times. But what you really, really need to know is you need to get the rate right. You need to understand what is the worker retention payment rate that applies to each of the individual employees that you'll be paying. You need to get the dates right. What period are you going to deal with firstly? And if I'm thinking about this right now, a level 3.1 educator has had a worker retention payment top-up amount from the 2nd of December to the 1st, to effectively the 30th of June, which is a particular dollar value. That dollar value is going to change in the first full pay cycle in July as a result of the annual wage review. So the first thing I'd be doing is making sure you look at this period, the 2nd of December to the 30th of June, and this is particularly pertinent for those who are going to receive their first payment in the 3rd week of July, and actually calculate the quantum of information you need to do that. But that is a really important period of time.
I would highly advise, just because, hopefully people are as stupid as me, but if I were doing it, I would do one payment that covers the those rates, and then I would split it into a second payment that covers the additional rates. And I'll tell you why moving forward, but that just makes it very, very, very clear what's going on for you, for your staff, for your accountant, and again, if you have to get back to the government and try and do a funding review.
And I think at its core, I think the next piece is really important. Get your communications right to your staff so that way they can feel assured that you're across this. And it's kind of like, calm on top and pedaling feverishly underneath as we navigate the exercise of it. But how getting the comms right as an addition to your payslip that really defines the period that you're covering with the pay rates, the number of hours that you're paying, and any of the relevant loadings that apply to those particular rates is very, very important for them to, understand this, because like us, they are doing something like this for the first time, and it's entirely fair for them to know what it is they're going to receive and what period they're receiving it for. This next thing you need to do is get your payslip right. So I think this is likely to be an out of schedule pay. The first back payment is likely to be some sort of out of schedule pay run out of your normal payment cycles from there. And it should very, very clearly say to staff, I'm paying you 550 ordinary hours at $2.91 an hour, which is one category. I'm paying you 35 personal leave hours at $2.91 an hour, and I'm paying you 100 annual leave hours at $2.91 plus 17.5% leave loading to it. So those three pay categories should be evident on the pay slip the first time, and that should be just a simple aggregation of all the hours that you've paid people for based on the date range that you're paying them for. And quite frankly, you can start doing that work well before you receive the payment to aggregate those hours using the reporting outcomes from there. This one is really critical. I will talk about the ACA workplace instruments. You may have your own workplace instruments. That is okay. Your workplace instrument obligates you to make the payment for the worker retention payment at a couple of interventions. Importantly, and this includes the MEA, your obligation to pay only exists when you have been approved for your grant agreement and received your first payment. Once you've received your first payment, you must, in a reasonable time frame, bring people up to date up to that point in time with their back pay, and subsequently ensure that you are paying the worker retention payment in any given pay period for every employee thereafter. That will mean that after the first back payment, because you receive your worker retention payment 1 month in arrears, you will be funding the additional top up until you receive your arrears payment, okay? But this is the legal obligation that the workplace, both the MEA and our IFA have in them, around the obligation to trigger that first back payment and then keep current with your payments in every single pay slip thereafter. And so I encourage you to do the preparatory work for arranging the back payment. The moment you've got your grant agreement, you can pretty much guess it's going to be the third week of the following month that you're going to receive your first worker retention payment amount. And that is the time that you must trigger your back payment based on the MEA or the workplace, our IFA. One other big important question in there is what if they have left since then, okay? This is our advice. We have validated this advice both with the department and with our industrial lawyers at ABLA. There's a really important threshold here that's in question. The department's advice around what happens if staff have left the service before you received and before you were approved and received the worker retention payment. It's a common question necessitated by the really lengthy approval times, because that's exacerbated this problem quite significantly. But the department's answer is it depends on what your workplace instrument says. Okay, that's what the department's answer is. So that, and I am providing this advice from ABLA based on the MEA and ACA's IFA. If you've used anybody else's IFAs, because there are multiple out there, the advice may be different because it may have different terms and conditions in it. Okay, so there is not one blanket rule that applies to everyone. Look at if you're not using our documents, you really do need to get independent advice on the terms and conditions of that. But there are importantly 3 thresholds for when back pay occurs. The first of which is you must have a valid workplace instrument, i.e. the multi-employer agreement or ACA's IFA in this case. So step 1, you must have 2, been approved to receive the grant. Step 3, you must have received your first payment. That's when your obligation to pay exists. Importantly, they all need to exist at the same time to qualify for back pay. That means that if an IFA or the MEA, and this applies to the MEA as well, right, if an IFA is no longer valid once somebody is no longer employed at the service. Therefore, that workplace instrument is not valid in relation to arranging back pay. And I did see someone online who was querying this there and said it is called a retention payment for a reason. It's about retaining staff. If you have left, that's not retention. So therefore, that is in principle this. But this does come back to what is the legal obligation, and the legal obligation means that if the workplace instrument is no longer valid, from an IFA perspective, it's no longer an active workplace instrument. If they're no longer employed, then and you hadn't received the grant yet, you're not obligated to pay.
Well,
Keep this in mind.
A couple of employers have come through and said, "Well, you know what? I received the money, and in all fairness, I'm going to give it to some of my staff who have left since then." Can they?
Look, I would say there is nothing stopping you back paying staff who have left if that's your choice to do, and if you're entirely fair to do that, and that is absolutely okay. That is your choice. I will say, I suppose, quite specifically, just be really careful about the rules that you make up for that situation, because it's no longer a legal obligation. It's a choice that you're making, which you're absolutely welcome you doing that if that's what you want to do. Just be really consistent with your decision making and make sure that my advice would be, if you've got multiple staff that have left, don't pick and choose which staff you're going to back pay if they've left. Either pay them all or pay none, because otherwise you might leave yourselves at risk of some other scenario playing out that might not work for you there.
Okay, so when you're setting up payroll, there's no formal requirement. The government haven't told us how we need to do this. But again, when we're talking about my little very, very poor accounting brain, I try and make sure that it's very clear for me. And it also helps you track when the annual wage rate changes, over the end of financial year, as well as when superannuation has just changed, so that you can report easily on this. I've highlighted here a standard pay slip, and what you can see is, if you ignore the highlighted bits, this person took 49 hours of annual leave, and you can see, as you are required to do, show the leave loading on it, and worked for 6.5 hours. You can just report it as the funded increase with however much you want to calculate it. But to be fair, it seems wildly complex to not, it seems a lot easier to set up a funded increase, dollar per hour. And in this case, you can see the worker retention payment increase is well below what this person is being paid per hour, because that's the award rate, not what they're being paid per hour. And that applies to the 6 hours that this person did work. And then you've got the worker retention payment with the annual leave loading of 17.5% applied, and that applies to their annual leave hours with the loading on it. And that extra loading, the difference of 58 cents, good maths, Nasha. The difference of 58 cents per hour is that historical leave liability money that's coming down. It also means that at some point you're going to be able to reconcile all of this a whole lot easier. So I would highly recommend whatever payroll system you are using, you set up 2 new pay lines and work out one that's based on the base rate and one that's based on any annual leave, knowing that the base rate covers things like sick leave, which doesn't have loading.
Nisha, do you have to set it up like that?
God, no. You could set it up a magical way. You can do whatever you like. What I would recommend, though, highly, is that you show very clearly what's the WRP payment, because it's going to make it easier for you to reconcile in the end when you're doing your reporting, rather than going back through and saying, oh, but I added this much to that amount and all of that kind of stuff. And it's also making it very clear for staff so that they're getting it in their heads. This is the WRP loading. This is what's going on here. That will come into play when we're talking about award increases, about gender undervaluation, and what happens at the end of this. So it doesn't, there is no legal responsibility for you to set it up separately. It means, but like I said, it means that you can do in my system, a really simple report to pull out the WRP with the annual leave loading, which shows that you've added leave loading and the earnings on the funded increase, and then do your own internal reconciliations rather than trying to go back through and use pencil and paper and things to work it out separately. So the next question is, how do you know if it's enough? We are in the process of, but it is a wildly complex thing that Paul threw at me earlier in the week, and I'm not that clever just this week, to go through. The income is very easy. You can go through and you can see here again the historical leave loading that doesn't come into your month to month to month. You can have a look at the total for periods. Fairly easy when you go into your provider entry portal, you can see that first payment and then the month to month to month payments that are going to come into you. When you're looking at what that's to be reconciled against, there's a lot of stuff that we need to take into consideration here. And we will do our best to at least give you a data sheet on how to go through and where to find these figures. But you're looking at, again, the pre-end of financial year with the figures that apply to that from the award rates and the super, knowing that at the other side of the financial year, you're looking at an increase in award rates and an increase in super. But it's only on the increase in super is only the worker retention payment. This is all very complex. Don't worry about this. You've got 2 other on costs to consider, which are payroll tax and workers' compensation. And they are going to be quite different state to state. They're going to be quite different insurer to insurer for workers' comp, as well as based on your past claims and things like that. So understand the reconciliation is easy in terms of what's coming in. What's going out is something that's going to be a little bit more complex, but our team will work through it with you and make sure that it's all either balancing for you, because we have been assured that it will cover at least 20% of on costs. And if it's not, then you need to be applying for additional funding. So, Paul, if I have done all the sums and I have insufficient funding and I need a funding review, we've got, well, there's actually 2 things going to come on the screen, but this is one of the first ones, and there's the second one, but we'll get to that. Talk me through the funding review.
Yeah, so look, the funding review is quite a rudimentary form. It's a pretty simple process. We're not going to talk through the form in every level of detail here right now, but it is pretty, particularly those who are receiving their first payments over the next little bit. It is, you're going to have a good body of time to determine whether the funding has been adequate for not, once you can prove that from a reconciliation perspective. The funding review process is really about your numbers. It is black and white. Have I been underfunded? How much will they top me up? And the department has been relatively efficient at being able to respond to those sort of things as well. You'll then be asked every 3 months to prove that you're still underfunded before they top that up. What I would say to you is that if you are underfunded, there is a very important date coming up, which is the 31st of October. So if you are underfunded and you want to apply for a funding review and you want to have it backdated all the way back to the 2nd of December, you must apply for your funding review before the 31st of October. Secondly, it doesn't stop you applying for a funding review after the 31st of October. It just won't be retrospectively applied, okay? So I suspect all of you on the call have applied for the grant, almost receiving the grant, are waiting for the final steps to take place. And I suspect most of you on the call will, by that time, have at least, should have received your first payment. And you will have 7, 8, 9 months of elapsed time to determine. That's a really good time to know whether you're underfunded ultimately, because you've had a lot of months of pay going out and children attending the service, and you should get on with that pretty quickly thereafter. Okay, it asks for some reason. It asks for some reasons why you might be underfunded. Do you staff differently? Do you do all sorts of things? But ultimately, it's a numbers game. How do you actually? How much have you paid out? How much have you received? They'll look at the gap from there. And I've probably answered this question. I've seen it come up in the chat, and I think it's really important to answer now. This is around when you're arranging back pay, what is the super rate you're going to pay on that back pay?
Oh, yes,
considering,
I forgot that. I asked this yesterday because I was still not sure.
Yeah, considering if you're paying your back pay in July, even though it was for the periods from December 24 to June 25, you are paying it in the new financial year, which means you will be paying the higher superannuation rate at 12% as compared to 11.5%, and that will need to be considered in any funding review process. That is absolutely the case, because you're actually paying. You're not reclassifying your previous year's pays. You're actually making a payment in July. So therefore, whatever the effective tax rate, superannuation, and other contributions will factor into your 25-26 arrangements there.
All right. Paul, can I just apply for the second year of the grant? Don't want the first year, just want the second year.
Yeah, you don't. I mean, this will come down to whatever the workplace instrument you choose to put into effect does. You can apply prospectively rather than look at retrospective receivement of funds. All I would say is you must, however, have complied with the fee constraint from year one. So that means you can't have increased your fees by more than 4.4% between the 8th of August last year and the 8th of August this year, even if you haven't received the worker retention payment in that time. So, so you can certainly just apply for the future at some stage, particularly post September 30 if you haven't done it by then, but the fee constraint still applies across the 2 years of the agreement.
This is a fairly easy one. We've just updated our wage tables. So ACA members can get this, and it includes a column that makes it so super easy for you about what the new rate is from the first full pay period after the end of financial year that you need to put in your worker retention grant based on their award level.
What I would say for everybody is, just before we move on from that, is that casual loading applies to that worker retention payment rate. That is the actual permanent worker retention payment rate, not the loaded rate there. So.
Yep, and it doesn't. That's the base rate. That doesn't include annual leave loading. Doesn't include casual loading.
Yep.
I am just in the process of updating our worker retention payment calculator. I just need to see if anyone else can break it before we release it to the public, which will, just like the old one, walk you through if you've got an employee here, blah, 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 blah. It basically makes sure that you're getting what needs to go on. So that will be available again within a day or so. So far, no one's broken it. So far, I've done well. Paul, can I absorb the annual wage review into this increase?
So I'll try to make this as straightforward as possible. If you were paying award rates previously and you're only paying the worker retention payment as a top-up payment for that, you cannot absorb the annual wage review into the worker retention payment amount there. So you would need to certainly apply the annual wage review into and then add the worker retention payment from there. The second part to that question, if you want to move to the next slide, sorry, Nisha, is that if you had an existing above award payment, which you are paying on top of the worker retention payment, you have the possibility of absorbing the annual wage review into the pre-existing above award payment, depending on how your employment contract is structured. So it is possible, but I would say seek some further support from based on the specific circumstances of your employment contract in order to determine whether that is allowed. That's not a worker retention payment issue, that's a legal contract issue. So just so you know. And I think the only other thing that I'd say is when gender undervaluation does take effect at some stage, and at this stage, the interim decision says that the first tranche of gender undervaluation decisions was supposed to be implemented from the 1st of August, although the proceedings are not concluded yet, so there is a bit of time with this, is that it will be absorbed as any gender undervaluation outcome will be absorbed, can be and will be absorbed into your worker retention payment. So ultimately, if you're paying the worker retention payment, whatever happens with gender undervaluation, you won't have to change anything about what you're doing at that stage. Yeah.
And if you're not, you will.
Correct.
Right. These questions are yours, Paul.
No, you don't. Nothing needs to change in relation to the workplace instrument as a result of the annual wage review. The IFA and the MEA have tables in them with the to December rates for worker retention payment, but they also make reference to this will change when the department updates its advice, and the department has updated its tables on its website with the new worker retention payment amounts that exist.
All right, and what about, again, do you need to update your workplace instrument once the gender undervaluation case is determined?
No. Look, so you won't need to change the workplace instrument, but again, the tables from the department will change based on whatever the final outcome is from the gender undervaluation decision, and therefore the live and appropriate reference point is the department's release of new tables as required, and they will specify what periods that applies from.
And ACA is likely to release some wage tables as well.
100%. We would have a whole range of things because beyond just higher rates of pay, the gender undervaluation decision deals with changes of classifications. We're not going to go into that today. There is a webinar that we've done on that with our good friends at ABLA, which goes into all the gory detail around the implications of that.
All right, well, we've just covered that off. Okay, so Paul, all of these questions that keep coming up on the hotline, who is covered? Are directors covered?
Yeah, so ultimately, an eligible employee is an employee that's covered by the Children's Services Award and the Educational Services Teachers Award, or can be classified under those awards, who work in a service, physically work in that particular service there. So that is a centre director, that is a casual, that is a trainee. The question with cooks and admin staff is a little bit different. If you employ your cook and they are classified under the Children's Services Award, and whether that be as someone who holds a cert or diploma, or someone who is classified as a support worker under the Children's Services Award, then they would qualify for the worker retention payment. Although if you employ them under some other award, then they don't qualify for the worker retention payment.
Such as the Clerk's Award for admin staff, or the Hospitality Award for cleaners, or
That's correct. That's correct.
And trainees?
Yep, trainees are covered as long as they perform the work, and there's some very specific language in the guidelines in that space there. So,
right, maternity leave.
Maternity leave.
Staff on maternity leave. Are they getting the worker retention payment?
The worker retention payment doesn't apply to the government's paid parental leave payments there. If you have some other arrangements in your organisation around paid parental leave for that you fund, that's a slightly different scenario, and therefore it would look like a different outcome there.
Or less.
Yeah, and it does cover all staff for all pay categories. So if they're sick and they're in receipt of personal leave, then worker retention payment applies to personal leave. Absolutely true. And the worker retention payment is based on the number of hours that you're paying them for. And so it is pretty simple under the workplace instruments. If you're paying them X amount of hours, they will receive a 10% top up if they have the valid workplace instrument in place, and obviously a 15% top up on the classifications of that there at that particular point in time. The question, good question in the chat around work cover. It really depends on what work cover arrangements you have for them at that particular point. And so, the life cycle of where they are in their work cover arrangements is really important, because clearly at some stages that the work cover insurer determines a percentage of rate that applies based on a whole range of formulas from there. That is a little bit more complex to unpack here, and as compared to someone who has taken 5 days off because they've had a short-term injury that you're paying them at full rate for. So we will look at that in that context there, and I would suggest we'll do some individual advice through the hotline for that.
Okay. Casuals, Paul, this has come up particularly from agencies as well. At the Queensland conference, I spoke to a number of agencies who were still negotiating their way through all of this.
Yeah, so look, casuals are pretty simple. Casuals are, you'll pay them a 10% top up based on their casually loaded rate from there. So, 25% of the permanent rate, as you're aware. And so therefore, that to me is a relatively simple exercise. Casuals receive a higher worker retention payment because it is under the IFA in particular, it's an all-purpose allowance, and all-purpose allowances attract loading to it from there. When it comes to agency hire staff and labour hire staff, there are some obligations that the government has released around funding of labour hire staff. But they've also put some pretty strict language on you being assured that the labour hire company is passing on that rate to that particular workforce before you agree to make those arrangements from there. We do have a fact sheet on that, and you can access that via the worker retention payment website.
Talk to us about what's going to happen in the future. I think we've gone through the award rate review and what is possibly going to happen, or what we expect to happen with the gender undervaluation case. Future award increases, how are they going to be managed? Which includes gender undervaluation essentially becomes an award increase, correct?
Yep, that's correct. So if we look at gender, I think we've covered the annual wage review. Okay, you can not absorb it into the worker retention payment itself. Can only absorb it into existing above award payments outside of the worker retention payment, assuming your contract allows you to do so. The gender undervaluation decision. So I would say the one way to think about it is, at the moment, the first tranche of the interim decision was to increase the award by 5%. Okay, the worker retention payment is 10%. That 5% ultimately is included as part of that 10% that's there. And so ultimately the worker retention payment, once the government releases new tables, would be 5% above the existing award rather than 10% above the existing award. Again, if you're paying the worker retention payment when the gender undervaluation decision comes, you do not need to change a thing. You just need to keep on paying that same amount of money, and you will be fully compliant with the arrangements. We will need to look at what the government releases in relation to its tables and the translation tables for classifications around gender undervaluation.
And we're 6 months in, 9 months in. What happens at the end of the grant period, Paul?
Yeah, I mean, there are, this is a bit of speculation, okay? And so there is an element there. And obviously many people, a large concern for the sector has been, well, what happens after 2 years? And that was before we knew that gender undervaluation was going to be phased in at some time. And that was, well, does that mean when the funding stops that educators go 15% backwards at that particular point in time to the award? And technically speaking, that was possible at that stage, that yes, your obligation to pay higher rates of pay would cease if the worker retention payment ceased. The second part to that is, well, as a result of the gender undervaluation decisions, the award will have increased by at least 10% by the time December 2026 arrives. If you're paying the worker retention payment, you would be paying 15% above the awards then, so the gap is only 5%. So if one thing happens, and that thing is that all of a sudden the government stops funding it at all, in theory, educator wages could go back from being 15% above the current award to 10% above the current award. That's, in theory, that is a possible scenario. We will have to wait and see what the government's intentions are in relation to what happens at the end of the grant period, particularly because those award rates will have lifted by that stage. And if there is no more worker retention payment in the future, very, very, very specifically, it would result in services having to increase fees to fund the pay rise, because if there's no worker retention payment, there would be no longer any fee constraint. I suspect the timeline for the government to indicate what its future direction system might be would be sometime between now and the federal budget next year. And by that stage, we would know what is likely to proceed from December 2026.
So we've got coming up some webinars planned. They are funding reviews, so looking at reconciliation, looking at all these kind of things, and including, you're going to have to remind me, Paul, again, to include things like workers' compensation payments now, because we haven't included that so far. The workers' compensation insurance, payroll tax, super, the difference in super, all of that kind of stuff is quite complex, but we encourage you to start at least tracking what's coming in and what's going out. The reporting requirements and deadlines. So there are in your, I won't flick back to it because it will take forever, but in your agreement that you have signed, you have agreed that you will report back in, I think it's October this year. There's a reporting deadline. We don't know what the requirements are for that yet. It is possibly going to be exactly what I was talking about earlier, saying what you have paid out in terms of the worker retention payment, which is why I'm encouraging you to set up a payroll system that makes that really easy for you, rather than having to go back through and trying to split out, oh, I remember what her award rate was at the time, but subsequently her award rate increased, but I didn't increase her dollar rate because I was paying her above award, blah, blah. Just make it as simple as you possibly can, and we will do a webinar on that. And of course, the gender undervaluation implementation and what that means, because we will go through that all again for you, which again, as Paul said, it depends on your workplace instrument. So I'm going to stop sharing. Yeah, we've only got 5 minutes. Go.
I'll quickly scroll through some of these questions. If I don't answer your question specifically, whoever's typed it in there, it's not for any specific reason, but I'll try to deal with what I think are the main ones that could be helpful here. Where you have multiple services, you're receiving one big payment, it is really hard to allocate it from service to service. I completely understand that concern. Ultimately, the government would want you to be would look at your funding in terms of its adequacy across all of your services, not just your services in isolation. But yes, it adds an extra layer of complexity there. There's a question around, when we're doing one big back pay, do we need to adjust tax for that back pay? I would suggest to you that you should probably speak to your accountant about what the best methodology is there. Ultimately, the reason we're doing a back pay has nothing to do with us as providers. It is to do with the government's processing times. Unfortunately, the impacts on tax and what that plays out is beyond your control, although it may be frustrating for your workforce. But if there is a way to adjust that, again, speak to your accountant so that they're comfortable with the decisions, or your payroll people so they're comfortable with those decisions. Yes, pay rates can adjust through the year if people move classification levels. That is entirely true. Where you need to move them, and then everything else that follows from there. I think we've covered that back payments would be ideal to have them as a separate payment. It will also assist you with your reconciliation. There's a question around, well, if we've already, so some people paid it up front. And so, if you've paid it up front, as long as you can report as to how you've received to assist you with your recommendations, that is okay at that particular point in time.
There's a question here on the historical leave liability is only for annual leave and long service leave. It also includes personal leave.
Yep, that's correct. What I would say, so where people, because this is around the issue of back pay, the money you receive won't change whether people have come and gone through the period of the grant, because the money you receive is entirely linked to the number of CCS session hours you lodge. So whether someone has left or not is not going to increase or reduce your pay from the government. When you reconcile with that at the end of the 12-month period in October this year, the government will do those calculations in terms of how it looks there. I'm just scrolling through questions as we work through that. And I will flag with you, and I know someone has raised this there. We were given evidence that the CCS Help Desk had given certain instructions around back payment to people which contradicted what I said. I have raised that very specifically with the department, who have provided advice to their help desk to be more correct in their advice to people. So yes, those of you who have said that the department have said this, they have said that. Don't disagree with you on there. The help desk should only be referring to the relevant workplace instrument that applies in that particular context, and not giving direct advice, because they're not lawyers who refer to the workplace instruments there.
I do want to point out, Paul, that someone has asked about whether or not you could just create a payroll category that is their base pay rate multiplied by 10%. And that deals with all overtime, all leaves, all whatever. I would point out that it's actually 10% of the award rate. It's not necessarily, unless you're paying all of your staff at award rate, it's not necessarily their base rate. So you can, if you're paying all of your staff at the award rate, then you could create another category for that, so long as you're applying all of the loadings in terms of annual leave and or casual rates. But if you are paying any of your staff even a cent above award, then it's, unless you're wildly generous in what you think you're going to do, but your obligation is only to pay 10% of the award rate, and that's all the government will be reimbursing you for.
I would say that there's a lot of frustrations with the various payroll systems and payroll organisations implementing this. Whilst I would not normally be sympathetic to people ensuring that people know how to do their job, there is a layer of complexity to this which makes it hard until it's embedded in your payroll system there, and how that translates from your timesheeting software and then transfers into it, because you can do it quite manually, or ideally most of the larger organisations would want to manually would want to automate that process in terms of when they bring the timesheet, that the allowance gets added to that there. So I get it. It is hard, but I think it is hard for everyone to do. This is not a standard arrangement. And so that complexity sits in every step of the process as it stands there. So, but yeah, it will take a little bit of time to get right. And ultimately, no one, if it is imperfect at the start, that's okay. We'll live and learn as we work our way through it. If your staff feel like they have been shortchanged in terms of it, I mean, this is where the comms piece is really, really critical. But yeah, it's not straightforward. It's not straightforward, and therefore, it is a bit of an imperfect science in working out how to do this, and how this works in your business, and how it works in different payroll packages, and how it works with different timesheeting. And I can see in the chat, we've got people with 1,000 employees, we've got people with 20 employees. How you do it in each of those circumstances is probably going to be very different, just because of the capacity to be able to do these things. So yeah, reflecting on this is critical. So the the back pay is probably, the first back pay is probably the easiest part of this process. Nesha points out one way of embedding this in your ongoing payment cycle moving forward. That is where the challenge is going to be harder to achieve there. But you know, we acknowledge, and we have advocated very directly to government, very directly to government around the complexities of this. I think that they've worked out how complex it is, and that's probably evidenced by how long it's taken to process approvals there as well.
And also the fact that there are now 8 agencies out there, one of us included, trying to guide people through this. It is incredibly complex. I'm going to wrap up, Paul, because we've come to the end of the hour. I really do encourage you all, while I'm going to leave the chat, to ask any more questions and/or email our team. If I'm really clever, I can share the screen again with the note. Do you know what? I'm not going to mess around because I screwed that up before we started. Jump onto the ACA worker retention payment website, get in touch with the team, ask them all of the questions that you want. We will put it up on the frequently asked questions page, and they're there to help you. It's a free service whether you're an ACA member or not. And I know that you've got lots and lots of questions, and I'll be scrolling back through all of this to make sure that it's all covered off. And most of it can be covered generally, but some of it is going to have to be an individual call. You're likely to get the wonderful experience of talking to Paul personally.
I think they hear my voice enough. Probably don't need to hear it anymore. So excellent. All right. Thank you, everyone. Have a great Thursday afternoon.